Good day friends, CEV Group welcomes you for watching this video. Please do not forget to like, comment and subscribe our YouTube channel Valuers Club for all new videos on various professional topics. In this video, we will discuss about the standards and compliances for valuers, in which we will discuss how we can anchor our professional excellence through these standards and compliances. So, this is a comprehensive exploration of regulatory framework governing valuation practice in India, examining IBBI, IBA, IBC, and CBC, CBDT standards that define professional excellence and compliance requirements. The regulatory landscape of valuation India in India, we will discuss in this slide how it was developed. The valuation profession in India operates within a sophisticated regulatory framework designed to ensure accuracy, transparency, and accountability. Four primary regulatory bodies that has been established and that governs valuation practice the in India are Insolvency and Bankruptcy Board of India, the Indian Banking Association (IBA), and the Insolvency Bankruptcy Code (IBC), and the Central Board of Direct Taxes. Each regulatory authority addresses specific aspects of valuation, creating a comprehensive system that protects stakeholders while promoting professional standards. Understanding these framework is essential for practitioners navigating India's complete financial and legal environment. These standards are not merely bureaucratic requirements, they represent the foundation of professional credibility and public trust. Compliance ensures that valuation withstand legal scrutiny, support sound financial decisions, and maintain market integrity. This presentation examines each regulatory framework in detail, exploring their requirement, interrelationships, and practical implications for valuation professionals operating in India's dynamic economic landscape. First of all, we will discuss about IBBI, the cornerstone of insolvency valuation in India. The Insolvency and Bankruptcy Board of India (IBBI), it was established under the Insolvency and Bankruptcy Code 2016 as a principal regulator for insolvency professionals, agencies, and information utilities. The IBBI plays a pivotal role in regulating registered valuers, ensuring that valuation services meet rigorous standards during insolvency and bankruptcy proceedings. Under Section 247 of the IBC, the IBBI is empowered to register and regulate various across multiple asset classes. This regulation extends to establishing educational qualifications, creating examination standards, developing codes of conduct, and implementing disciplinary mechanism. The IBBI's framework ensures that valuations performed during insolvency resolution processes are credible, independent, and methodologically sound. So now we will discuss about the IBBI Registered Valuers framework. First, we will discuss about registration requirements. Valuer must register with IBBI recognized valuer organization and meet stringent educational and professional experience criteria specific to their asset class. So next is asset class specialization. IBBI recognizes seven distinct asset classes: land and building, plant and machinery, securities and financial assets, and others, each requiring specialized expertise. Sorry, it is three distinct asset classes which IBBI recognizes, that is land and building, plant and machinery, and securities and financial assets. And this IBBI also provide code of conduct for registered values, and it requires that registered values must adhere to the strict ethical standards including independence, subjectivity, confidentiality, and professional competence in all engagements. The IBBI framework establishes a comprehensive regulatory architecture that governs every aspect of valuation practice, from initial registration through ongoing professional development, thorough ongoing professional development, and disciplinary oversight. IBBI valuation standards. So IBBI has detailed valuation standards that prescribed methodology, approaches, and disclosure requirements. These standards align with international and best practices while addressing India-specific contexts. But the key technical requirements are mandatory use of appropriate valuation approaches, market, income, and cost methods, comprehensive disclosure of assumptions, limitations, and uncertainties, clear documentation of data sources and analytical processes, independent requirements to prevent conflict of interest, timely completion within prescribed timeframes. So compliance with these standards is non-negotiable. Valuers face disciplinary action, including suspension or cancellation of registration for violation of professional misconduct. Next is IBC, which is Legislative Foundation for Corporate Insolvency. The Insolvency and Bankruptcy Code 2016 represents a watershed moment in India's economic reforms, establishing a unified and comprehensive framework for resolving corporate insolvency and bankruptcy. The IBC fundamentally transformed India's approach to distressed assets, shifting from a debtor-friendly regime to a time-bound, creditor-driven processes. Valuation occupies a central position within IBC framework. Accurate, reliable valuations are essential at multiple stages of insolvency resolution process, from determining liquidation value and fair value during resolution planning to assessing whether resolution plans meet standard threshold. The IBC explicitly recognized the critical role of registered valuers in ensuring that stakeholders receive fair treatment and that resolution process achieve optimal outcomes. Valuation requirements under IBC. So, what are the requirements under valuation of valuations which are to be done under IBC? First thing is mandatory dual valuation. The section 35 of IBC requires two registered valuers to determine both liquidation value and fair value of corporate debtor, providing a comprehensive valuation framework. Second thing is as far as liquidation value calculation, how it is to be done, it has been described. Liquidation value represents the estimated realizable value of the assets if sold individually in a forced sale scenario within a specified time frame, typically under distressed conditions. And as far as the fair value assessment is concerned, fair value represents the value of the corporate debtor as a going concern, reflecting the business operational continuity and future earning potential. And then resolution plan threshold. Resolution plans must provide creditors with the value not less than the amount they would receive under liquidation, making account accurate valuation critical for plan approval. So how this IBBI valuation process is done, what are the timelines for various things to be carried out under this valuation procedure. First thing is between day 0 to day 30, corporate insolvency regulation process commences. Interim regulation process professionals are appointed under this IBC valuation within 30 days. Then from 30 days to 54 days, two registered valuers are appointed to conduct independent valuations of liquidation and fair value. Then between 54 to 75 days, valuers submit detailed valuation reports with methodologies, assumptions, and supporting documents. Then from 75 to 180 days, resolution plans evaluated against valuation benchmarks. Committee of creditors review and approve plans. Then between 182 to 70 days, NCLT approval process. Valuation reports serve as a critical evidence for plan viability and fairness. So the IBC prescribes strict timelines within the entire CRP process to be completed within 330 days. Values must comprehensive reports within narrow time frames while maintaining technical rigor. So next is the most important thing, the evaluation which are done under banking sector. You know, when the loan is to be given by mortgaging the property, then valuation is to be done, and based upon the valuation the amount of loan is decided by the banks or by the financial institutions. They have given certain guidelines for banking sector valuations, and these guidelines have been given by IBBA, that is Indian Bankers Association. They have issued comprehensive guidelines governing property valuation for lending purposes. These guidelines address the unique requirements of secured lending, where property valuations form the basis for credit decisions involving substantial financial exposures. Core IBA valuation principles are independence of valuers from lending decisions, periodic reevaluation of security to reflect current market conditions. It means after 2 to 3 days, 3 years, again the revaluation of the property is done to reflect the car value of the property as on date. Then prudential reforms for valuation adjustment based on property type and location. Documentation standards ensuring traceability and auditability. Risk-based valuation frequency depending upon the loan size and asset classification. IBA guidelines complement regulatory requirements from Reserve Bank of India, creating a comprehensive framework that protects both lenders and borrowers while ensuring financial system stability. So IBA means Indian Banking Association. So banks have their own panel values who are appointed for doing the evaluation. So in this slide we will discuss about the panel value requirements. First thing is professional qualification. So valuers must possess recognized professional qualifications such as IBBI registration, membership in recognized valuation institution, or relevant technical certifications. And then depending upon the type of job or work for the valuers, they must have certain experience. Minimum professional experience requirement vary based upon the loan amount and the property complexity. typically ranging from 5 to 15 years for high value transactions. Then banks maintain approved panel of valuers who undergo periodic performance reviews ensuring consistent quality and adherence to standards. Then strict protocols prevent valuers from assessing properties where they have personal or financial interest, ensuring objectivity and independence. Means you have to maintain conflict of interest. Valuation standards for security secured lending. So IBA guidelines prescribed a detailed methodology for property valuations in lending context. The primary objective is to determine the market value that can be realized within a reasonable time frame, typically 12 to 18 months under normal market conditions. This differed from forced sale liquidation scenario. Banks apply loan to value ratio as prudential limits with the valuation serving as the denominator. For residential property, RBI regulations cap LTV ratio at 70 to 90% depending upon the loan amount, making accurate valuation critical for determining maximum lending limits. Commercial property typically attract lower LTV ratio reflecting higher market volatility and longer liquidation periods. Revaluation requirements vary based upon asset qualification. Standard assets may require revaluation between every 3 to 5 years, while non-performing assets demand annual or more frequent revaluation to reflect determining conditions and market changes. And the next thing is valuation for taxation purposes CBDT, Central Board of Direct Taxes. It regulates valuation for taxation purposes under Income Tax Act 1961. Tax valuation serves multiple purposes, determining capital gains, assisting gift tax implications, computing wealth tax when applicable, and evaluating transactions for transfer pricing compliance. CBDT has prescribed certain specific rules under various sections of the Income Tax Act that mandate valuations by approved values. These provisions ensures that transactions are assessed at the fair market value, preventing tax avoidance through undervaluation or overvaluation. CBDT framework differs fundamentally from insolvency or lending valuation. It focuses on establishing taxable value rather than realizable or secured value. So, here the basic thing is the difference in the calculation procedure. Whereas in IBBI or IBCI or IBA, you have to find out realizable or secured value. Here we have to find out taxable value for CBDT means for taxation purposes. So key CBDT valuation provisions are there are certain sections under which the valuation is done. First section is section 56(2). This is for immovable property received without consideration or for inadequate consideration is taxable as income from other sources. If value exceeds stamp duty value by specific thresholds, then section 56. So capital gains on transfer of immovable properties are computed based on stamp duty value if it exceeds consideration subject to safe harbor provisions and valuation appeals. Then section 142A, the valuation of assets by the department valuation officers in specified circumstances where fair market value determination is critical for tax assessment. So these provisions create a comprehensive anti-avoidance framework requiring valuers to understand both technical valuation principles and complex tax legislation to ensure compliant defensible valuations. Then registered valuers under income tax rules. So we have approved valuers under CBDT. CBDT maintains a list of approved values qualified to conduct valuations for specific tax purposes under different tax provisions. Valuation methodology. Tax valuations must employ Recognized methodologies appropriate to asset types, comparable sales for real estate, DCF for business, and net asset value for unlisted securities are some of the methods which may be used depending upon the situation. Then documentation standards. Detailed valuation reports must support tax filing, including market analysis, comparable transactions, and explicit assumptions clearly documented. So, convergence and divergences across various frameworks. So, this graph shows the convergence and the divergence across various frameworks: IBBI oblique IBC insolvency, IBA high value lending, IBA standard lending, CBDT capital gain, CPDT wealth tax assessment. So while these frameworks share common principles, objectivity, independence, methodological rigor, they differ significantly in purpose, methodology, emphasis, and outcome requirements. So practitioners must navigate these distinctions carefully, recognizing that a valuation appropriate for one regulatory context may be insufficient for another. So this is important thing for the values to know, that valuation appropriate for one regulatory context may be insufficient for another. This is most important thing to remember. Then common compliance challenges. First is conflict valuation standards. So different regulatory framework may produce varying valuation for identical assets due to purpose specific methodology. Liquidation value under IBC differs materially from fair market value under CBDT, requiring careful explanation and documentation. And then documentation and disclosure requirements. So each framework demands specific documentation formats, disclosure levels, and supporting evidence. Incomplete or inconsistent documentation is a primary source of regulatory scrutiny and potential liability. Then time constraint and quality pressure. So IBC timelines, banking transactions, deadlines, and tax filing schedules often compress valuation works into narrow window, creating pressure that can compromise thoroughness and accuracy if not properly managed. So this is important thing for a value to remember. And then market data availability. Indian markets often lack transparent, readily available, comparable transaction data, particularly for specific assets or properties in tier 2, 3 cities, requiring values to exercise professional judgment supported by alternative evidence. So these are certain common compliance challenges under various valuation requirements. Then for a values, they must maintain professional best practices for compliances under different valuation methods. First is, you as a valuer you must have technical excellence. You should maintain current knowledge of regulatory updates, judicial precedents, and across all frameworks. Develop asset class specific expertise recognized by regulatory body. Employ multiple valuation approaches to triangulate value and support conclusions. Document all assumptions, limitations, and uncertainty explicitly. Retain comprehensive working papers and supporting evidence for audit trails. Then, as far as ethical standards are concerned, maintain absolute independence from transaction outcomes and stakeholders' interest. Disclose all potential conflicts of interest proactively. Refuse engagements where independence cannot be assured. Provide objective, unbiased opinions regardless of client preferences. Committed to ongoing professional development and certification maintenance. So, professional excellence in valuation extends beyond technical competence. It encompasses ethical integrity, transparent communication, and unwavering commitment to serving the public interest. enforcement and disciplinary mechanisms under different valuation regulatory authorities. So, regulatory authorities possess extensive enforcement powers to ensure valuer compliance. IBBI maintains a disciplinary committee that investigates complaints, conducts hearings, and imposes penalties ranging from warning and monetary fines to suspension or permanent cancellation of registration. Recent years have witnessed increased scrutiny and disciplinary actions reflecting regulatory commitments to maintaining professional standards. Banking regulators conduct periodic audits of valuation practice, with RBI inspections examining valuation processes, panel valuer selections, and compliance with LTV norm. Deficiencies can result in regulatory censure, restrictions on lending activities, and reputational damage. As far as CBDT is concerned, its enforcement includes rejection of valuation deemed non-compliant, reassessment of tax liability with attended interest and penalties, and potential prosecution for deliberate undervaluation or fraud. Tax authorities increasingly scrutinize valuations, particularly in high-value transactions. So, future valuation standards are concerned. As far as valuation standards in India are concerned, there are many things which are being introduced recently and which will be very soon introduced in India. First thing is technical technology integration. Emerging technologies including artificial intelligence, big data analytics, and blockchain are transforming valuation practice, offering enhanced accuracy, transparency, and efficiency while raising new regulatory questions. Then, international harmonization. So, in today's scenario, international harmonization is very important. So, in all the fields, similarly in Indian valuation fields, India's valuation standards are progressively aligning with international valuation standards, facilitating cross-border transactions and enhancing credibility in global markets while preserving domestic context sensitivity. Enhanced professional development. So, regulatory authorities are expanding continuing education requirements, requiring and emphasizing specialized knowledge and ethical training to elevate overall professional standards and public confidence, especially the IBBA, which is emerging as the leading regulator in enforcing these continuous education requirements and training and rigorous selection procedure. So the regulatory landscape will continue evolving, driven by market development, technological innovations, and lessons learned from insolvency cases and financial crises. Practitioners must embrace continuous learning and adaptation. So in the end, we can understand how we can anchor excellence through compliance. So, standard and compliance represents far more than regulatory burdens. They consider and constitute the foundation of professional credibility, stakeholders' protections, and market integrity. The framework established by IBBI, IBC, IBA, and CBDT creates a comprehensive architecture that guides valuation professionals towards excellence. Mastering these standards require technical expertise, ethical commitment, and dedication to continuous improvement. Valuers who embrace compliance as an opportunity rather than an obligation distinguish themselves professionally and contribute to India's economic development. And now, what is the path forward demand? So rigorous adherence to regulatory requirements, commitment to professional development, ethical integrity in all engagement, and recognition that valuation serves the broader public interest beyond individual transactions. So this is all in today's video. Please go through this video and give your suggestion in the comment box to make improve further in these videos. And if you have anything to comment and to make corrections if there is anything wrong, you can comment or directly send the messages to CEVIAF review. Thank you for watching this video. Have a nice day. Thank you very much.